All right, welcome to this explainer. Today, we're diving into something pretty exciting. We are going to walk through the complete financial literacy curriculum that honestly should have been mandatory education for all of us back in high school. We're going to take those complex, often super intimidating personal finance concepts and break them down into actionable, stress-free systems that you can literally start using today.
But first, $246 billion. Just let that number sink in for a second. That is exactly how much Americans lose every single year. And we're not talking about losses from bad luck or economic downturns. No, this is purely because of what people don't know about money. We're talking about totally avoidable overdraft fees, high-interest debt, and investment returns that are just left sitting on the table.
So, the crucial point is that the financial industry has largely been built right on top of that confusion. They profit immensely from it. Because of this everyday knowledge gap, the average person loses roughly $1,000 every single year. Now, over a 40-year career, you might do the quick math and think, okay, that's 40 grand lost. But because of lost compound interest, that $1,000 a year could have actually grown into over $270,000 by retirement. That's a massive difference. We're talking about a down payment on a house or 5 years of retirement income just entirely gone.
To stop that invisible theft, here is our exact syllabus for today. First, finding your financial baseline. Second, mastering debt and credit. Third, building your wealth system. Fourth, navigating major life purchases. And finally, protecting your financial future. Think of this as our roadmap to completely demystify your money and build some stress-free systems.
Okay, step 1, finding your financial baseline. Let's figure out exactly where you stand.
Do you actually know the gap between your yearly income and your actual expenses? Look, before you can make any real progress, you need a crystal clear, radically honest snapshot of those numbers. And notice we're looking at this yearly, not monthly. Why? Because a yearly view captures all those sneaky surprise bills and annual subscriptions that completely derail a monthly budget. And this brilliantly illustrates the biggest misconception about wealth out there. People constantly confuse income with net worth. Your income? That's just the money that buys your lifestyle. But your net worth, meaning everything you owe minus everything you owe, that is what actually buys your freedom. Having a super high income but a low net worth is essentially just running on a treadmill. You're sprinting incredibly fast, but you're going absolutely nowhere because you're designing a life meant to consume every single dollar you generate. At the end of the day, your financial surplus is what buys you options. Moving on to Section 2, Mastering Debt and Credit. Let's talk about avoiding the traps.
Right now, Americans hold an astonishing $1.277 trillion in credit card debt. The average household carries a balance of over $11,500. And with average interest rates, that's costing them over $2,500 a year in interest just to stand still. It's crazy. Debt compounds against you in the exact same way investments compound for you. So, if you're dragging around this anchor of bad debt, you need a strategy to attack it. There are two main ways to do this. The debt avalanche is mathematically optimal. You pay the minimums on everything and throw every extra dollar at the debt with the highest interest rate. Then there's the debt snowball, which is psychologically optimal. You throw every extra dollar at the debt with the smallest balance, so you get those quick, motivating wins. So which one should you choose? Honestly, just pick the plan you will actually stick with. A mathematically perfect plan that you give up on after a month is totally worthless compared to a slightly less efficient plan that you actually see through to the end.
Now, if you want to avoid bad debt in the first place and get those favorable loan terms, you've got to understand how your credit score actually works. This 3-digit number basically dictates what borrowing costs you. 35% of it is your payment history. That means a single missed payment can wreck your score for years. Another 30% is your credit utilization, which is just how much of your available credit you're currently using. You want to keep this below 30%, but ideally keep it below 10% if you can. And you know what's funny? Things like your actual income or your bank balance, they don't factor into this score at all. It is purely a measure of how you handle borrowed money. All right, step 3, building your wealth system. It is time to automate your future.
Okay, let's dive into this. Once we've stopped the bleeding from high-interest debt, it's time to shift our focus over to playing offense. But to build a real system, vague aspirations just aren't going to cut it. We need a specific, time-bound framework, like the 50-30-20 budget. The basic idea here is that 50% of your after-tax income goes to absolute needs. 30% goes to wants, like dining out, hobbies, that sort of thing. And 20% gets locked away for your future savings and investments. Now, these aren't strict, rigid commandments. They're more of a flexible starting point. The real magic here is that this framework creates awareness. It takes your unconscious, reactive spending and turns it into conscious, intentional choices.
So what exactly should you do with that 20% for your future? Well, any money you're going to need in the next 5 years should absolutely go into a high-yield savings account. But money you don't need for decades, that needs to be invested.
Check this out. To put this into perspective, if you save $500 a month for 30 years at a 4% yield, you'll end up with about $349,000. Not bad, right? But if you invest that exact same $500 a month into a broad S&P 500 index fund, which averages historical returns around 10%, you end up with $1.1 million. It's the exact same monthly effort, but the power of compound interest in the broad market index fund completely eclipses standard savings.
Now, to really supercharge those investments, you want to take advantage of tax-advantaged accounts. You basically have two main flavors of individual retirement accounts, or IRAs. A traditional IRA gives you a nice tax break today, but you'll have to pay taxes when you withdraw the money in retirement. A Roth IRA, on the other hand, means you pay taxes today, but all that massive compound growth we just talked about, that is entirely tax-free later. It's huge. But, quick side note, before you fund either of these, always make sure you contribute enough to your employer's 401k to get their full company match. If they match your contribution, that is an immediate guaranteed 100% return. It's literally free money, so do not leave it on the table.
Step 4. Navigating major life purchases. Let's talk about the big stuff, like cars and houses.
So let's transition to the area where most people accidentally destroy their wealth: cars. By 2026, the average monthly payment on a new car is expected to be a staggering $770, and that's often stretched out over crazy 7-year loans. Just think about that for a second. You're paying massive interest on an asset that is rapidly losing its value the literal second you drive it off the dealership lot. To protect yourself from trading your future wealth for a present-day transportation status symbol, use the 24-10 rule. Here's how it works. You need a minimum 20% down payment. Your loan term should be a maximum of 4 years, and your total monthly vehicle expenses, meaning the payment, the insurance, and the maintenance combined, should be less than 10% of your gross monthly income. If you can't hit those numbers, you are quite simply buying too much car. Scale down, or better yet, buy a reliable used car and let someone else take that initial massive depreciation hit.
And then, of course, there's the biggest purchase of all: housing. We really need to break this widespread myth that renting is always a waste of money. Yes, buying a home builds equity and offers stability, absolutely, but it also comes with massive transaction costs. We're talking inspections, closing fees, the whole shebang, plus a rule of thumb maintenance cost of about 1% of the home's value every single year. When you rent, on the other hand, your capital is completely free to be invested in the stock market instead of being tied up in a down payment or a sudden need for a brand new roof. The math here is actually pretty clear. If you plan on staying in an area for less than 5 years, the flexibility and the lack of hidden costs that come with renting almost always win out.
Section 5. Protecting your financial future. It's time to build a defense.
Now, what's really interesting about this slide is that accumulating all this wealth means absolutely nothing if you don't build a defense system. You have to transfer catastrophic risks away from yourself and over to insurance companies. These policies are the literal firewall between you and financial ruin. Health insurance? That's non-negotiable. One hospital stay can wipe out decades of hard-earned savings. You also need proper auto insurance and homeowners or renters coverage. If anyone depends on your income, you absolutely need term life insurance. And crucially, don't overlook disability insurance, which replaces your income if you're injured and unable to work. Seriously, your ability to earn is your greatest asset. Protecting it ensures that an inevitable life emergency just acts as a temporary inconvenience rather than a permanent wealth destroyer.
Finally, Section 6, the action plan. Let's turn all this knowledge into actual results.
Okay, we've covered the complete curriculum, but you know as well as I do, knowledge without action is just entertainment. So let's move to action and see how this builds your exact time-bound execution roadmap. This week, I want you to calculate your net worth and start tracking your actual expenses. This month, set up that high-yield savings account for your emergency fund and confirm you are getting your full 401k match at work. This quarter, pick either the avalanche or snowball method and execute your debt attack plan. And finally, this year, automate all these goals so your money moves before you even see it, and commit to reviewing it all quarterly.
Look, the ground doesn't have to crumble beneath your feet, but you do have to stop walking toward the cracks. You're no longer in the dark about this stuff. You understand exactly how debt traps people, how compound interest builds massive wealth over time, and how to protect your hard-earned assets. You now know the rules of the game. So the only question left is, what will you do with them? Take everything you've learned today, act on it, and go build the financial freedom you absolutely deserve.